It never starts with everything collapsing. There's no single moment where the system suddenly breaks, no clear warning that something massive is about to unfold. At the beginning, it looks small, contained, almost irrelevant. One bank, one problem, one crack. And that's why it gets ignored. Most people think banks fail on their own. One makes bad decisions, it collapses, and the rest of the system moves on. Clean, isolated, manageable. But that's not how the system actually works. Banks aren't separate. They're connected, constantly lending to each other, relying on each other, exposed to each other in ways that aren't obvious from the outside. And as long as confidence holds, that system works perfectly. Money moves, credit expands, everything appears stable, until something small goes wrong. Because the real risk in a financial system isn't failure, it's what happens after. The moment one institution shows weakness, the rest of the system has to react. Not emotionally, but strategically. Are we exposed? Can we get our money back? Do we pull out now or risk losing everything? And that's where the shift begins. Not a collapse, but a change in behavior. Banks stop lending as freely. They start protecting themselves. Liquidity tightens, not because money is gone, but because no one wants to be the last one holding the risk. This is the part no one sees. From the outside, everything still looks intact. But underneath, the system is already changing. Trust starts to disappear. And once trust goes, the entire system behaves differently. Because banking isn't built on money alone. It's built on confidence. The belief that everything will keep working the way it always has. The moment that belief is questioned, even slightly, the system starts to unravel. This is how one failure spreads. Not instantly, but inevitably. One bank pulls back, then another, then another. Money slows down. Credit dries up. And the connections that once made the system strong begin to turn into points of weakness. What was once support becomes exposure, and what looked like a contained problem starts moving through the system. This has happened before. In 1931, Europe was already fragile. Economies were under pressure, confidence was low, and the financial system was far more connected than most people understood. At the center of it was Credit-Anstalt. It wasn't just another bank. It was one of the most important institutions in the region, deeply tied to businesses, governments, and other banks across Europe. On the surface, it looked stable. But underneath, it was carrying problems that had been building for years. Bad loans, hidden losses, weak foundations that hadn't been fully exposed. At first, those problems didn't seem enough to bring it down. Something that could be managed quietly. But then confidence started to slip. And that's when everything changed. Because once people began to question the bank, the problem stopped being internal. It became systemic. Other banks started reassessing their positions. Investors started pulling back. Money didn't just move, it started leaving. And in a financial system, outflows are what break everything. Withdrawals increase, lending slows, pressure builds, and the bank at the center of it all begins losing the one thing it cannot operate without: trust. Once that's gone, there's no simple fix. Because what looks like one bank failing is actually the moment the entire system starts to break. What happened next wasn't a sudden collapse. It was a reaction. Once confidence in Credit-Anstalt began to weaken, the system didn't wait to see what would happen. It started adjusting immediately. And those adjustments are what turn a problem into a crisis. Other banks didn't panic at first. They calculated. They looked at their exposure, their loans, their connections. And quietly, they began to pull back. Not dramatically, not all at once, but enough. Because in banking, you don't need everyone to react. You just need enough institutions to become cautious at the same time. Lending slowed, then it tightened, then it started to disappear. And this is where the system begins to turn against itself. Because banks rely on constant movement, money flowing between institutions, credit being extended, positions being rolled over. When that flow slows down, pressure builds underneath. Credit-Anstalt wasn't just dealing with its own losses anymore. It was dealing with a system that was beginning to isolate it. Depositors started to notice, not the full picture, but enough to feel something was wrong. And when depositors feel uncertainty, they don't wait for confirmation, they act. Withdrawals increased, at first manageable, then faster, then all at once. This is the moment where a bank stops functioning like a business and starts fighting for survival. Because banks don't keep all your money. They rely on the assumption that not everyone will ask for it back at the same time. But when confidence breaks, that assumption disappears. And the system is forced into a position it was never designed to handle. Credit-Anstalt couldn't meet the demand, not because it had no assets, but because those assets couldn't be turned into cash fast enough. So it turned to support. The Austrian government stepped in, then the central bank, then international institutions. But here's the problem. Support doesn't restore trust. In many cases, it does the opposite. Because the moment a bank needs to be rescued, the market understands something deeper is wrong. And that realization spreads faster than any official response. Other banks across Austria began to feel the pressure, then Germany, then beyond. Because once one major institution is questioned, every connected institution becomes a potential risk. Banks stopped trusting each other, not emotionally, but structurally. They reduced exposure, pulled back funding, refused to roll over short-term loans. And that's when the system truly begins to lock up. Because modern financial systems don't collapse from losses alone. They collapse when money stops moving. Liquidity disappears. Even institutions that are technically stable begin to struggle, not because they're insolvent, but because they can't access the funding they need to operate. This is how a contained failure becomes a systemic crisis, not through explosion, but through restriction. Germany's banking system came under pressure next. Mass withdrawals, capital flight, institutions weakening under stress. Governments began taking extreme measures. Restrictions on withdrawals, controls on capital, emergency interventions designed to stop the bleeding. But by this point, the damage was already spreading. Because confidence doesn't return just because authorities say it should. It only returns when people believe the system is stable again. And in 1931, that belief was gone. International investors started pulling money out of Europe entirely. Capital didn't just move between banks anymore. It left countries. And once that starts happening, the crisis moves to another level. Because now it's not just banks under pressure, it's entire economies. Currencies weaken, trade slows, financial systems begin to fracture along national lines. All from one failure. What started as a problem inside a single institution had now become something much larger, a chain reaction. And this is the part most people never fully understand. It wasn't the size of the original failure that mattered. It was the position of it within the system. Credit-Anstalt wasn't just a bank. It was a point of connection. And when that point failed, everything connected to it had to adjust. Those adjustments didn't stabilize the system. They pulled it apart. And by the time the full scale of the crisis was visible, the system wasn't just under pressure anymore. It was breaking. By the time the system starts breaking, it's already too late. Not because no one saw it coming, but because by the time it becomes visible, the underlying problem has already spread too far. What happened in 1931 wasn't just a crisis, it was a demonstration. A clear example of how financial systems actually fail. Not from one event alone, but from the structure that connects everything together. Because the uncomfortable truth is this: the system didn't fail despite being connected. It failed because of it. That same structure that allows money to move efficiently, that allows economies to grow, that allows credit to expand, is the exact same structure that turns small problems into system-wide failures. And that hasn't changed. Modern financial systems are even more connected than they were back then. Banks don't just operate within one country anymore. They operate globally. Capital moves instantly. Exposure isn't always visible. And risk doesn't stay where it starts. Which means the same pattern still exists. One point of weakness, one institution under pressure, one shift in confidence is all it takes to start the process again. Because at its core, nothing about the system has really changed. It still runs on trust. It still depends on liquidity. And it still assumes that everything will keep working until it doesn't. That's why crises always feel sudden, even though they never are. The pressure builds quietly. Weaknesses sit beneath the surface. Connections tighten. Exposure increases. And then something small happens. Something that, on its own, shouldn't be enough to break anything. But it isn't the size of the event that matters. It's where it happens. When that event hits the wrong part of the system, everything connected to it has to respond. And those responses are what create the collapse. Not chaos, not panic, but structure reacting to stress. That's what makes financial crises so difficult to stop. Because once the system starts protecting itself, it begins to work against itself. Liquidity disappears. Trust vanishes. And the mechanisms that normally hold everything together start pulling everything apart. This is why one bank can break everything. Not because it's the biggest, not because it's the worst managed, but because it sits in a position the system depends on. And when that position fails, there's no way to isolate it. It spreads through balance sheets, through lending, through confidence, until the entire system feels it. And by the time people realize what's really happening, the collapse isn't starting. It's already in motion. That's the pattern. And it's one that repeats over and over again. Different countries, different banks, different time periods, same structure, same outcome. Because as long as the system relies on trust and constant movement, it will always be vulnerable to the same kind of failure. And most people won't see it coming. Not because it's hidden, but because it never looks big enough at the start. Just one bank. Just one problem. Just one moment where confidence slips. Until everything starts to break. And by then, there's nothing left to stop it. This is what empire economics is about. Breaking down the systems that shape how money really moves, how power is really built, and how these patterns keep repeating beneath the surface. If you want to understand what's actually happening in the world economy, not just the headlines, but the structure behind them, make sure you're here for the next one. Because the next shift won't look obvious either. And by the time it does, it's already too late.